Sammy and I were thinking that it's about time we talk about all of the critiques of ESG investing that have been taking hold in conservative circles recently. Isn't that right, Sammy? She's asleep. But before we get too into it, let's just give you a sample of what you might have found if you turned on Fox News at one point in the last couple of months.
Environmental, social, governance. Well, the acronym ESG is a classification and rating system that globalists are now using to pressure American companies into adopting progressive practices at every level of their operations.
If ESG investors were as effective at pressuring companies to adopt progressive practices as Laura Ingraham seems to think they are, I wouldn't have gone to the trouble of starting my own firm. I would have just gone to go work for one of them. ESG investing has changed tremendously over the years that I've been paying attention to it. When I first sort of became aware of the term back in 2012 or so, it was the sort of thing that only true believers would be talking about. Between then and now, it has absolutely snowballed into something that every large asset manager seems to be advertising their competence in. A proliferation of products. I think 121 new ESG funds of various sorts were launched last year, and that doesn't even count my strategy because I'm not a traditional fund manager. So, there is a lot of interest, there's a lot of assets, there's a lot of marketing attention, and I don't think it's crazy for media to be critiquing a lot of the overselling that happens around this space. However, there is also a broader question that a lot of folks are raising. They are arguing that ESG investing is one, bad for returns, and two, bad for the broader world in that it creates inflation and pushes up gas prices. So we're going to talk about that directly. First, let's look at the returns equation, because I think that for a lot of people, they don't think about investing outside of returns, right? This chart shows you how about 1,500 different funds have performed over the last 5 years. On the bottom down here, we have alpha, which is outperformance relative to the index, right? And being further over here means that a fund has performed better. Being further over here means that a fund has performed worse. On the left-hand side, we have beta, which is a measure of volatility. Being higher up means more volatility. Being lower down means less volatility. Now, one of the things that we get instantly from looking at this chart is that the traditional universe of fund managers has quite a wide spread in terms of its performance. Over here, we see folks that have generated a lot of volatility but not added much in the way of value. Over here, we see folks that have generated a lot of volatility and added a fair bit of value. And then sort of down here, you see, what really this business is all about, which is folks who are adding value with comparable volatility to the underlying index. One of the things that I really want to underline is that even though I could probably launch a very detailed critique of almost every single one of these active sustainable funds and passive sustainable funds, the way that they've been doing things meaningfully constrains the scope of outcomes in kind of a good way, right? What I mean by that is if you were to pick an arbitrary US equity fund, you could wind up performing all the way over here, all the way down here, all the way over here, all the way up here, right? In sustainable investing, that range of outcomes is a lot tighter. And that is kind of great for investors because it means that investors can generally rely on sustainable managers to deliver something that is roughly in line with the universe of opportunities that they have access to. Whereas in the broader US equity market, it's kind of harder to know for sure what you're going to get from your asset manager. So when pension plans start to discourage folks from looking at sustainability criteria, one of the things that they're really missing out on is this ability to have a tighter range of outcomes, which is exactly the sort of thing that we want. Another argument that's taken hold in some circles is that ESG investors are responsible for inflation, in part because they have discouraged investment in new fossil fuel projects and tend not to own stocks in any fossil fuel companies and tend also to pressure folks to not lend to or finance new fossil fuel projects. Let's take a look at why that might be. A lot of fossil fuel companies have had great returns over the last year. After Russia invaded Ukraine and energy prices generally went crazy everywhere around the world. And a lot of them have taken the opportunity to strike out and critique ESG investors for, quote unquote, missing out on the opportunity to hold their shares. This chart, which is very similar, although slightly different from the last one, shows total returns, not relative performance, on this scale, and standard deviation on this scale for all of the sectors of the S&P 500 index. And what I've done to make it a little bit easier to read is put energy in pink, which I'm sure those guys will love, and all of the rest of the sectors in purple. Now, what do we see here? We see that the energy sector has generated the most volatility and the lowest returns over the last 10 years relative to the other sectors in the S&P. So just by excluding it from an S&P fund, which is behind, I think, a lot of the performance over the history of some funds, just by excluding it, managers could add a lot of value. So I think it's a pretty red flag when you see, supposedly sustainable managers rushing to integrate oil and gas companies into their strategies after a few months of good returns. And I would encourage everyone to kind of keep this in mind as they think about energy and how it fits into their portfolio, because there are definitely periods where energy is a great performer, but overall, I would argue that many investors are perfectly fine excluding it from their portfolios. Now, whenever I or my colleague here starts talking about how investing in the energy sector is a great way to destroy your capital over time, and it's the traditional energy sector I'm talking about here, one of the things we often hear back is like, yeah, but if we don't invest in energy, where are we going to get energy? And that's a reasonable concern. I think there are a couple of things that I would point out in response to that. The first is that there are a number of specialist funds that exist only to provide energy funding to energy projects, right? Both in debt and equity and all sorts of stuff. And really, there should be no shortage of capital available for high quality projects with a good chance of generating returns. That's how the free market works. There are still trillions, literal trillions of dollars in subsidies that are directed to fossil fuel production and consumption around the world, including here in the US. And I think that to compare, the diffuse and, in my view, not particularly effective influence of ESG funds to the omnipresent and, unavoidable effect of these government policies really puts into stark relief how frivolous the conservative critique of ESG investing really is. So if you are the type to have been thinking about this, I hope this video somewhat sets your concerns at ease, and I would love any questions that it produces. Thank you for spending some time with me.